As of 30 June 2022, Asian dollar bonds movement in June was volatile as investors sell off assets in the run-up to the Fed's policy meeting on June 16. This was followed by a cautious buying in the second half as the Fed delivered its first rate hike since December 2015 at 75 bps. However, this was insufficient to offset on the first half of the month. Global investors shift back into the higher quality bonds while avoiding the riskier assets, which are the lower quality credits as they are more exposed to the recession risk. This led to the Asian dollar HY index falling below the Asian dollar index, Asian dollar IG index, and also the Asian dollar corporate index. Malaysia's economy was negatively affected by the country's weaker growth outlook due to its vulnerability to inflation shocks and the slowdown in the global growth. The Malaysian government security broadly mirrored the movement in the US Treasury yields over the months, largely due to the concerns about the growth and inflation in the country. Following the larger than consensus US non-farm payrolls, the 10-year US Treasury yield rose above 3% at the beginning of the month. Market participants responded by adjusting their expectations of the Federal Reserve monetary policy tightening. Furthermore, the local bank yields track rose in tandem with the global core rates, with the discounting being most prominent in the 5 to 10-year time horizon of the curve. Local market participants were closely monitoring the government's intention to eliminate fuel and food subsidies. In parallel with the above bond performance, several issues related to the Malaysia bond market have been raised, such as flattening yield curve, the rating of foreign currency, and last but not least, a climb in interest rates. These issues are believed to be correlated with the foreign inflow.
Many issues had arisen due to the pandemic which had greatly affected the Malaysian bond market. The International Monetary Fund (IMF) stated that ravages of the new COVID-19 epidemic have made the prospect for the global economic recovery very dubious. In its World Economic Outlook 2021, the COVID pandemic has an impact on the economies of every nation. Thus, this project objective are to identify the impact of COVID-19 pandemic on the Malaysian bond market, to study the movement of the current yield curve in Malaysian government securities, to identify the current foreign flow in Malaysian bond market, to study the interest movement which affected the bond market. And this project seeks to identify relevant issues related to the issue of foreign inflow in Malaysian bond market. We wanted to clarify how it is related and suggested ways to overcome this issue.
The main point of view is the yield curve, where it is a graphical representation of interest rate structure and illustrates the relationship between bond yield and maturities. The expansion of the bond market is encouraged by the existence of a benchmark where Malaysian government securities, or known as MGS, is selected as a benchmark yield curve Malaysian bond market due to its risk-free characteristic. According to the article of the Age Market written by Tan Siew Mung, Malaysian Rating Corporation Berhad estimates a flattening yield curve of the MGS in 2022, and the decline in foreign holdings of local government debt is expected to continue in the short term with a weaker ringgit. However, it is estimated that there is a small rise in MGS yields based on the growing yield margins between MGS and large government bonds, which can attract investors that look for yields. As the market became more flexible, the flattening of the yield curve was primarily affected by the increased participation of foreign investors in the ringgit bond market. It can be proven when phases of flattening yield curve were primarily driven by an increase in portfolio inflows. The decrease in longer-term rates is worsened by structural challenges in the ringgit bond market, especially in liquidity conditions in a rising bond market. Moreover, the demand of Malaysian debt market was also increased by high real yields despite continuous consumer price deflation in 2022. As a result, more supply issues may push inflation to levels that central banks find unpleasant or weaken that already weak economy recovery. This is because some nations' inflation rates have already risen significantly over their monetary policy objectives. The lowering of the yield curve and the narrowing of the maturity spread is a significant issue that has happened in the ringgit bond market. Based on our estimation, a higher presence of foreign investors in the domestic bond market, whether represented by foreign investors holding of debt securities or the level of net portfolio inflows, is statistically significant in contributing to a decline in longer-term yields. The phenomenon of the lowering yield curve in the ringgit bond market have been mostly driven by an increase in ringgit bond market portfolio inflows. Therefore, bond issuers should consider buying back their bonds against the cost of new financing when interest rate is low.
Foreign bond market in Malaysia has high currency risk exposure due to the bond prices in dollar. When income from a bond yielding 7% in a euro currency is turned into dollar, the exchange rate will follow too. For example, decrease the yield to 2% due to the exchange rate differences. Multinational corporations and government often issue the bond denominated in various currency to take an advantage as the purpose to reduce the borrowing rate and to match currency inflow and outflow. According to Malaysian Branding Corporation Berhad in 15 December 2021, the local bond market foreign flow slipped into negative territory in November after 3 consecutive months of positive net foreign flow. It is due to the bond market has facing a high sell-off with a net foreign outflow more compared to foreign inflow. According to article of the Malaysian Reserve, bond investor will have recorded the first negative return on Malaysian government bond in 15 years due to the demand of equity or other asset classes more compared to debt in the relation trade team with the opening of economy from COVID-19 industries, lockdown and restrictions. Malaysia has shown the worst performance Ringgit Malaysia among regional currency, which is due to the Ringgit Malaysia has shown depreciation 3.8% against the US dollar. Investors interested in foreign bond and usually include foreign or international bond in their portfolio for several different primary reasons, but with the same purpose, which is to take an advantage of higher interest rate and to diversify their holding. However, the greater projection return from investing in foreign bond is associated by an increase in risk due to the unfavorable currency changes.
Now for point rising in interest rate, currently in Malaysia, Bank Negara Malaysia officially joined as one of the countries which increased their interest rate in order to cope with the inflation. Recently, Malaysia has raised its overnight policy rate OPR to 2% from a record low of 1.75%, where it had been since July 2020. This action will indirectly affect the performance of the bond. This may be due to the fact that a monetary policy such as the OPR has a significant impact on the bonds. According to what we have read from the article US Securities and Exchange Commission, when interest rate increase and hence it will lead to the prices of fixed rate bond decline. Nevertheless, not all rising interest rates are bad. The particular reason for this circumstance is, first of all, for the short run, higher interest rate may reduce the value of a bond portfolio. However, in the long run, increased interest rate can boost the overall profit of a bond portfolio. This is because money from maturing bonds can be reinvested in higher yielding bonds. After that, rising in OPR can influence the country's foreign exchange rate. This is because a rise in the OPR can quickly lead to an increase in a currency foreign exchange rate. This is due to the fact that investing in a country with higher interest rate will result in surge in demand for the currency and a rise in its exchange rate. For example, an exporting country like Malaysia will raise the cost of its export. Generally, higher interest rate raise the value of a country's currency and tend to entice foreign investment, increasing demand for and the value of the home currency. During the COVID-19 era, the OPR rate was reduced. However, with global economies reopening and strong domestic growth, the Monetary Policy Committee (MPC) of the Bank Negara Malaysia (BNM) has decided to start reducing the degree of monetary accommodation. This is actually to ensure that it will be implemented gradually in order to support the nation's sustainable economic growth while maintaining price stability. As a result, by increasing the OPR, it will not only prevent inflation, but it will directly increase the foreign inflow as it is higher in demand.
In conclusion, bond prices changes in response to the shifting market attitudes and economic conditions. The yield, current interest rates and bonds rating have the most impacts on a bond price. Luckily, Malaysia's economic recovery is anticipated to continue to be robust in 2022 as business activity picks up after more restrictions were eased and international crossings were reopened. For recommendation, by affecting the discount rate, changes in interest rate has an impact on bond prices. Increase in interest rates due to inflation necessitate a larger discount rate, which drive down bond prices. The prices of a bond is also influenced by credit risk. Bonds with greater yield and lower prices are categorized as speculative bonds because of their increased risk and lower credit ratings. The yield on the bond must rise and its price should fall if a credit rating agency reduces the paper's rating to reflect high risk. One of the key institutions needed to promote economic activity is the bond market. To maintain solid performance as the market changes, market procedures need regular upkeep. As a result, it is imperative to regularly review and re-evaluate the essential building pieces and ecology.